Hey, good afternoon, everybody. This is Chris Robinson, Robinson Ag Marketing, with this weekly private member podcast. I'm going to cover about 20 charts here today, digging a little bit deeper. I really want to point out specific levels of what I'm looking at with new crop soybeans, as well as how much more of a retracement bounce can we get possibly in cattle. I'm going to start sharing my screen with you here right now. Just bear with me 1 second. And here we go. There is and here we go. All right, we're going to start with the first. Here we go. This is the member podcast, Robin's Ag Marketing for December 2nd, 2025. This is what we're going to be covering. And you can go back and obviously freeze these, repeat, so on and so forth. I'm going to try and get a little bit quicker presentation so I don't waste your time. I'm going to cover everything there except for gold and silver and the S&P. Not enough time to cover all that stuff today. I think the big risk is corn, wheat, and beans right now, and cattle. This is the disclaimer. There's risk in trading futures and options is substantial. Each investor and/or trader must consider whether this is a suitable investment. Past performance, whether actual indicator by simulated historical tested strategies, is not indicative of future results. If you know anything about my program, my whole idea on how to manage risk is try to keep you in a position where you can make better cash sales and also just address the risk that you have in the cash market. These hedges are defensive in nature. A put option is a substitute sale, which lets you capture a chunk of revenue and actually hold on to your grain. And then you have the choice, rather, as you move down the line, whether or not you actually want to make the cash sale. But options are the tool that I use for the defense. The put option, usually it's just a long option strategy. Sometimes we'll get in situations where we'll sell options and collect premium, but 99% of the time, 90% of the time, it's straight long options to defend our risk, and vice versa. If we have $1.50 soybean rally and you can't bring yourself to sell a bushel because you're afraid it's going to rally another $1.50 the minute you call the elevator and say sold, then we buy a call option. You make the cash sale, you re-own the call option. If the market keeps rallying, the call option makes money. You're in the rally. You're not going to get 100% of the rally. If we do our job well, we'll get you 70, 80%. But that is the strategy. Sometimes guys can't bring themselves to do what the most important thing to do is, which is to make a good cash sale. And buying a call option can help you make the cash sale, especially if you keep it cheap. All right, let's get after it. Like I said, this is slide number 4 of about 20. So if you've been working with me or watching these podcasts, you know that we've been looking at this chart for a long, long time. It's a long-term chart of December 2025 corn. Back originally when we started doing these, we just come off the August contract low, and we're like, how can we bounce? Can we get up to this 460 level? That was a big target we had for a long, long time. If you update that to where we are now, well, it comes in right around 450. That's the different times to make the same trend line. So here's the interesting thing, and what I want to start off with is there's 10 more business days until December gets off the board. Most people aren't trading it right now, but some of you will be pricing grain based on what D's corn is or your elevator. Why is that important? Well, in 12 days, we could very easily rally 12 cents and get up to that 450 level. And I resent out all the cash sale recommendations that I had. So I've got targets all the way up to 450, making cash sales. Please look at that email. If you didn't get the email, give me a call. I'll send it to you. And you can see the notes I put down here, basically just reiterating what I just said. Now, we did make a cash sell a while ago when we hit 439, and then we went a little bit higher. We hit 442, and then we fell 20 cents. I mean, my goodness, last week it looked like we were going to roll over and play dead. Now we've rallied back. We've had some good exports, some great exports, a lot going to Mexico. So they've been gobbling it up here. In anticipation of trying to get, take advantage of the fact that we're basically, when we're down here at these levels, we're at 4-year lows in the price of corn, right? So if you're an end user, you want to take advantage of it, and that's what a lot of these countries have done. So very, very important. Watch 450 in the next 12 days. All right. This is what we were talking about the last meeting. We still haven't gotten this 13 to 14 billion dollars, right? We heard a lot about that during the shutdown. It has not showed up yet. A lot of guys are waiting for it to show up because it's about that time of the year to start paying for some of your inputs, right? The other question was, did the media help put the low in for beans? It sure felt like it. When that November options expired and we were going into the meeting in South Korea, it could have gone either way. A lot of people out there pounding their chest, because we ended up having a $1.57 rally from that October low. That's great. We did use it to make cash sales, but as we make cash sales, I always told guys, hey, re-own it for 10 cents, 12 cents. Those 10 or 12 cent options, for those of you that did it, really kept us in the game. And again, at the end of the day, my plan is based on getting you good cash sales, the best cash sales we can, without having a crystal ball, without having ESP, without knowing where the highs are going to be for the year. Let's face it, if I knew that, first of all, I wouldn't tell anybody. Second of all, if we really did know that, why would we hedge at all? We would just wake up, on vacation and say, oh, today's the day we need to sell our corn. So that's not the way the world works. That's why we hedge. Nothing's changed in South America. Still no weather delays, no planting issues, no drought issues so far. So that's not an issue yet. All right. So for the corn that you're storing in the bin, I want to get this off the screen. I don't know why it's there. Maybe I can move it. All right. I'm going to close it. Move it here. There you go. We're into March 2026. And what's important about where we are right now, I can get this thing out of the way here, which I probably can't. Maybe I can. There it is. Today we popped above the 200-day moving average right here. And we also went back to the halfway point of the entire year's trading range. This was the high back in February. This was the low in August. This 450 area. And we've been here before, sports fans. We thought we were going to really go after it back here and completely fizzled. So we're back up in it one more time. It's a bit of a mulligan. Are we going to be able to see 460? That would be the next upside target. But 450 is certainly a very, very key area here. We did pop above it today. We may get some more follow-through buying. I hope we do. If you've got corn in the bin, keep a floor. Most guys that I'm working with have either 430, 435, 425 floors, trying to make sure that we don't get caught with our hand in the cookie jar if we slam lower between now and the end of January. Okay, so moving on to 2026 corn. We don't have a lot to work with there. We've had a 73.5 cent life of contract range right down here. You can see what I'm talking about. The contract high back here in 2023 was 512.5. The low down here, 439. So we've been dancing around this 467 level here for a while. I do have some cash share recommendations, which I've sent out there. If we can get something close here to 475, I think that would be a good place to start. We have another potential target up here. Above it here, it's about 480. I don't know if we're going to get there, but if we do, we're going to want to do something. Now, a lot of people are looking at this chart and saying, when are we going to get back here? I think that's going to take some sort of a weather issue. So I don't want to be aggressively bearish here right now, but I do want to maintain a floor. I want to keep the upside open. I also want to make sure that if you do make cash sales, that you re-own it, because 2025 was very weird. We did not get a weather scare. I don't think the same thing is going to happen in 2026. All right, here we go with January soybeans. This was the $1.50 rally I was telling you about. And look, when we headed into that meeting in South Korea, we were right down here. People were worried about taking out, $10 beans, 980 beans. So this was not a very easy decision to say, okay, hold. we had puts on right here because we were worried about us going back down here. So anybody that tells you, oh yeah, we knew we were going to rally $1.55 in 5 weeks, they're completely out of their mind. I think that a lot of the reason we rallied and we don't have confirmation of it yet is I think the Chinese bought the dip on the board in anticipation that they were going to make some sort of a deal with Trump going into that meeting. So excuse me, they kind of front ran their own buying news. They have not bought a lot in the cash market yet. I think what's going to happen, and again, I have no confirmation of this, but I think what's going to happen is that we're going to get down the road and they're going to say, oh yeah, we bought all these beans back down here around 10 12 10 15 10 20, and now we're going to go ahead and take delivery on them, and that's how it's going to work. But no confirmation of that yet, but it wouldn't surprise me. It's kind of what it feels like. Again, I could be wrong. I don't bet the house on it, but we have not seen these guys buy more. They've bought 2 million metric tons. They need to buy another 10 million metric tons, and it's not showing up. You got a lot of corn buying, but no actual physical grain being bought. And why would they? We have the most expensive grain here in the U.S. compared to the rest of the world. So it's going to take a while to shake out, but I think this might be what this was all about. In any event, we got to take advantage of it. It gave us 17-month highs, right? That's the key. Take advantage of it. Well, lo and behold, here's November 2026 soybeans. Again, we were back here, down here, concerned about what happens if we, took out 1040 or $10 beans. And you guys were absolutely positively worried about this when we were dancing back here at 1040. I can tell you that for a fact. So to have us go to 1140 and right up here, we didn't quite get to 1142. We got to 1131. That is a gift. That is a gift, a gift, a gift. I thought anything above $11 was a good hedge, and a lot of you did too. And right now, you can defend $11 on the board for a dime until the third week of January. So you could defend through two USDA reports for a dime. And after a dollar 45 rally from where we were this time last year. So this is a great opportunity. A lot of guys think that, oh, for sure, we're going to go get into this gap and fill this gap, and then we're going to be off to the races. But there are people, that's what they do for a living. They just promise people, huge markets every year because they're kind of singing to the choir. I'm trying to be realistic. Okay. I want to make sure that we don't have any hedges or any sales south of $11 all year. That's what I want. Okay. I hope that we get to sell $16 beans. I hope that our worst sales are right here, 1130. Right. And that's why I would say defend everything for at least 6 weeks or so here for about a dime. Defend $11 beans. And then if you do make cash sales, absolutely positively re-own it. Re-own it. Because I don't want to be looking at $12, $13 beans going, oh, why did we sell anything back here at 1130? Didn't people know? And the answer is no, nobody knows. So we hedge. All right. A real quick look at soybean meal. Again, soybean meal had a nice bounce. Couldn't take out these old resistance here. This is a big multi-year, 2-year down move here. We came back and clawed back almost 62% of it. We've been dancing around this level here. I would definitely watch 313, 312 the rest of the month of December. If it's going to hold or not, we'll certainly know. I think the best soybean rallies are always led by meal. But again, we have the most expensive meal on the planet. So it's going to take a lot of heavy lifting to get us up there based on supply and demand and what our costs are compared to the rest of the world. All right, soybean oil. There's been a lot of back and forth about what's going to happen with the RINs and what's going to happen with overall policy towards biodiesel. We had this huge rally, and then when they started talking about, wait, we're going to kick the can, we're not going to have a decision. Well, we darn near gave back half of this huge rally, right? So we've kind of paused here for the cause now. This last little rally in soybeans helped pull us up in the oil and meal together. I think this is an opportunity as well. Most people aren't that sensitive to soybean oil. If you are in the canola business, however, they kind of go hand in glove together. I would say this: it's nice to see a rally in bean oil when you're watching crude oil drift lower. Crude oil is in danger of taking out, multi-year lows. If we take out $55, that'll be a 5-year low. So that's something to watch there. If lower soybean oil prices would hurt you. Okay. What happened today? Well, there was a threat, and I'll just let you read. That's the whole story. But basically, 2 days ago, we were talking about possibly the war being, getting wrapped up, some sort of a peace deal, and lo and behold, Mr. Putin got mad and uh, because of the attacks in the sea of the on the oil tankers here. You can read all about it, right? So the spook today was this spooked the market was they might cut off Ukraine's maritime access. So that's a risk, and that gave us kind of a turnaround Tuesday in wheat. We went from a six week low to a higher settlement, barely higher settlement on the day. We'll see if this thing has legs or not. I would continue to watch that. I believe there's the wheat chart. This is July 26th, soft red winter wheat. And this is what we've been doing, been drifting lower, drifting lower. Today we made a 6 week low and then turn around and settle a little bit higher. But we still been in this big downtrend. So wheat is really struggling to get anything going on. Fundamentally, there's nothing bullish out there in wheat. If I'm growing wheat in 2026, I want to make sure that I'm defending, this contract low down here, this 530 level. You don't want to see anything worse than that. We did have a nice rally. A lot of people got jazzed up here. We had about a 50-60 cent rally. We've given it all back. So wheat is kind of the redheaded stepchild. It doesn't get any love, and it's always the first one to get beaten down if anything turns at all. That's just the way it is, sadly, for wheat. We don't have there's certainly no shortage of wheat worldwide. All right, and here's cotton. I was asked by some guys to talk about cotton. We are still here at this, basically we just came off the lowest price since July of 2020, 5-year lows. Is it going to go worse? I don't know. I was looking at December 2026 cotton moving ahead. I would definitely do something here. Here we go. We don't want to see sub 60 cotton in 2026. This is next year's cotton, next year 2026 Christmas cotton. We're just kind of hanging out here at this 70-cent level. A lot of guys, would love us to get back up to these, 80 cents level, which we were higher up back here in 2024. At the end of the day, we know what we can defend, right? We can defend this contract low. So defend 66, 65. Hope that you don't need it. You don't want to get caught in a situation where we've got sub 55 cotton, and you could have done something here to defend. So defend. It's kind of hanging in no man's lane. It's going to be very, very sensitive to what goes on with weather. It's going to be very, very sensitive to what goes on with China. China, remember, is the biggest producer and the biggest end user out there. So they really, really impact. Real quick, here's crude oil. I was talking about crude oil earlier. Look at this wedge. You tell me this. If we take out the April low, this 55 and 12 level, that's going to be a 5-year low. Nobody's talking about it. This was the high that we had when we bombed Iran, and we've been slipping lower ever since. And I drew a smaller version of this trend line, but look at how influential this trend line has been. For the past 6 weeks, we've just been going back and forth on that trend line. This $58 level has been very, very, very big. And then, so we're coming to the apex of this triangle, this wedge. If we do go below, if we go sub 55, that won't be friendly for commodities that go higher as crude oil go higher. There's no two ways about it, right? So I would watch that carefully. The only good part of that is it has helped diesel. So there's heating oil, diesel. I mean, my goodness, 3 weeks ago we were at 6-month highs. We were flirting. This would have been about a if we had taken out this high, it would have been, I think, about a 18-month high. So we were right up there, big resistance. Now we're falling over again. I would say if we get down here around 220, 217 area, and I noted this here, that might be an area for some of you who want to step in and set hedges because we may be stuck in the between these two lines here, um, bumpers on a bumper car, right? We just tend to bounce back and forth between those two silly lines. All right, guys, we're moving on. I'm trying to go as fast as I can. Feeder cattle. This was the correction that we started out with, and this is about a week and a half ago. We just started November, right? We had the correction. We started the bounce. A lot of people thought, oh, this 38% is going to hold. We're going to have to go up and get this gap. Well, fast forward to what happened. Boom. We never went and got that gap. We dropped 88 and a half cents. We made 5-month lows. And then now, in this week, in the last 2 weeks, we've gone from, the low here, this 293 low. We've almost hit 326, 320, 325.70. That would be the 38% retracement. We kind of stalled out there. A lot of guys are looking at the halfway back here at 33. And then can we fill this gap, which comes in at 46? I put this in the letter every day. We watch it every day. I will say this, and I know some of you set hedges down here because we sort of chased it all the way down and, for whatever reason. For the hedges that we set down here, I'm going to be talking to you about, hey, do you want to spend $1 and go up $4 or $5 on your hedges? Do you want to move your floor up? That's when it's nice to have a put on as opposed to suppose you have been short futures down there. I mean, my goodness, we've rallied, a big chunk in just the last 10 days. So if you're short futures, you got hammered. This is when options are your best friend. If you bought a put down here, yeah, okay, maybe you spent 5 cents a hundredweight, and it's probably worth still three or 2.5 right now. It hasn't gone completely worthless. You get the chance to say, do I want to spend another $1 and maybe move your floor up $4 or $5 or $6, depending on how high we can do it. That's a much better decision, a much better conversation to have. Saying, do we want to roll up our puts and get a higher floor? Do we want to do that? Versus if you're short futures and you're sending in margin money and you're adding insult to injury. You're hedged down here. You're leaving all this profit on the table and you're making margin calls. So this is exactly when puts work better than being short the futures. Guys always say that. Give me an example when that's the case. Here's the case. If you have a put right here, you still have the floor, but you have the choice to roll it up. If you sold futures here, yeah, you've got a floor, but you've been making margin calls all the way up. That, in a nutshell, is why options are generally your better choice if you're hedging volatile markets. And right now, cattle is very volatile. We're going to switch over to April fats. Same thing. This drop here was almost 46 cents a hundredweight. And lo and behold, today we clawed back 38%, 222.80, right? Are we going to go to a little bit higher, get up here to this 230 level and then possibly 233? Are we going to go hit the halfway back? It's possible. We're going to find out tomorrow. But same thing goes. And if you work with me, you know that I was aggressively trying to roll our puts down. If we had puts up here that all of a sudden were worth a lot of money, I tried to roll them down here and get paid, maintain a floor down here. But in anticipation of, well, I want to have a cheap put on down here. I want to have a cheap put go worthless on a rally rather than a really expensive one. If you had a put that you paid $5 for up here that was worth 20 down here, and if you didn't touch it, if you didn't roll down, now it's gone from 20 to maybe 10 very, very quickly. So you've lost all that potential dough. So that's why we roll down puts. We only do it if the math makes sense. But if you've got puts on with me, I'm going to be calling you. I probably called you today already. We're going to be trying to roll them up if you want to. Okay. And what's going to be the criteria? If we can spend $1 and go up $5, $6, or $7, then we'll do it. If we can't, we'll stay with our original hedge. All righty. Lean hogs. This was a chart that I had for about, 2 or 3 weeks, maybe a month, talking about what happens if we hit this silly trend line down here. Well, I can tell you, boom, we hit it, and now we bounced a little bit. So are these trend lines perfect? No, but this is the reason that I use them, because they are simple. Number one, you got to keep things simple. Number two, they're one-stop shopping. Number three, they let you do what everybody hates to do, which is make a decision. What do I want to do if we hit here? And then, if we go below this, what are you going to do? If we rally back, what are you going to do? So there are key points for you to do one thing, and that's to reassess your hedge, reassess your risk, and decide what you want to do. I had a bunch of guys when we hit this line, and I put it in the letter. I said, hey, if you were unhedged and if you just sold a couple pot loads here into this ditch, why not re-own with a cheap call, right? And that's a cheap call. It's a way to re-own anything you just sold here, because who am I to say that we can't rally back up to this level? I have no idea where we're going to go. And the moment you start recognizing that nobody knows where we're going to go, what we're trying to do is make the best decisions we can based on the information we have. A month from now we could be down here, but boy, if you're a producer and you own these animals, you want us to be up here. You want us to go back up here. And then what's the last one we're going to do? Okay, yeah. Here's April lean hogs. Here's the daily chart for April hogs. This was the correction we had. And from here to here, right, we dropped almost 14 cents. This was today. This was Friday. So on Thursday, we hit the 38% at 86, basically 86.30, right? Now, are we going to keep going to 87.5? Are we going to get halfway back? I do not know. Today they sort of bought everything across the board. We'll see. So, but in the meantime, even if you just said, okay, what am I going to do? I don't have any hedges on. I would say, hey, for sure, make sure that you don't let anything get south of 81. That will be our starting point, right? And I want to keep this upside completely open. Hopefully we get a rally back up here to 90 cents. But if we don't, I want to make sure that we've got 80 cents covered, because I don't want to be trading at 75 cents going, oh, we could have done something up here at 82 or 83 or even 81 and we didn't do anything. So that's why we hedge. All right. I hope it didn't take too long on this. I hope it made a lot of sense to you. I did send out the numbers again for the cash sale areas that I'm looking for old crop corn. We're closing in on what we're doing for new crop corn. It's a great opportunity to set a hedge in new crop soybeans. I can't stress that enough. I also want to leave you with this idea too. Setting a hedge is not calling a top. Setting a hedge is not getting bearish. Setting a hedge is capturing revenue. And if you're a grain marketer, you are a speculator. The only problem is you're a speculator with one hand tied behind your back. You're always long. So if you're going to be following me, I'm always going to be talking about defend the biggest risk that we have and try and do the best that we can. All right. Thanks for joining me. Have a great rest of the night. And call me in the morning if there's anything I can do for you. Take care.